It all ignited with a single phone call in Beijing. No flashing headlines, no grand announcements. Just one cold, precise message slicing through the noise. Stop buying dollars. Not a polite request, a direct order. Within 48 hours, Spain dropped a bombshell. A sweeping economic pact with China so seismic it rattled NATO's financial core to its bones. Anyone still calling this a trade spat? Already obsolete. 5 moves behind in a chess game no one fully sees yet. Behind closed doors on April 7th, the order tore through China's colossal state banks like wildfire. No posturing, no symbolic gestures, pure ruthless execution. ICBC, Bank of China, Agricultural Bank, all instantly obedient. Dollar exposure? Obliterated. Settlements rerouted through the Yuan. Dollar liquidity. Frozen cold as ice, not a drill. The opening salvo of a sprawling new war. The timing surgical, precise. 2 days after Trump escalated tariffs. 1 week after U.S. Treasury yields rocketed to heights unseen since before the 2008 financial collapse, shaking markets from Wall Street to Frankfurt. Washington faces a brutal reality. Is China methodically dismantling the dollar's supremacy right now, live in plain sight? Wall Street stares back, stunned, powerless. No consensus. Just fear creeping into every trading floor. Goldman Sachs' Hui Shan warns bluntly, if China pulls back from the dollar, global liquidity could implode overnight. Then the brutal numbers drop like bombs. March 2025 saw China dump $24.1 billion in U.S. Treasuries, the sharpest monthly retreat in 7 years. No nuance, no ambiguity. This was a shot fired across the bow, clear, calculated, unavoidable. Then Spain made its move. No hand-holding with NATO, no tiptoeing past Washington, just ink on paper and triumphant grins. A multi-billion euro embrace of Beijing's capital. China entwined deep in Spain's lifeblood, logistics, energy, innovation hubs. Valencia, Bilbao, Algeciras. Strategic gateways rewired by Chinese money. Hidden in the dense legal text. Incentives for electric vehicle manufacturers, rail integrators, rare earth miners. The largest bilateral investment since 2005. No European Union sign-off required. Speed and stealth. Timing? Not accidental. 2 days earlier, Trump hurled a 100% tariff at European EVs, accusing China of tech dumping. Spain didn't flinch. They chose their camp. Former EU Trade Commissioner Cecilia Malmström called it, old loyalties? Dead. Everything transactional now. And when allegiance is just numbers on a spreadsheet, what happens when the math shifts underfoot? April 6th, the White House suddenly pulls the brakes on a $50 billion tariff wave targeting Chinese tech and autos. The media calls it diplomacy. The bond market howls something darker. That day, 10-year Treasury yields surged to 4.81%, a level not seen since the era before the crash. Behind the scenes, the data screams, $67 billion in U.S. debt jettisoned in the first quarter alone. China, Japan, Saudi Arabia leading the charge out the door. Morgan Stanley's chief economist spells it out. Without foreign demand for U.S. debt, the entire system is exposed, politically toxic, economically untenable. Is this tariff pause a tactical chess move or a red flag of panic? The sell-off intensifies. The ominous question grows louder. What if America's creditors just keep walking? What happens when the safety net tears? Meanwhile, China accelerates at full throttle. No hesitation. In March 2025, exports to the Global South exploded 42.6% year over year. Electric vehicles, electronics, industrial tools speeding ahead. Exports to Mexico and Spain skyrocketed 18.3% and 21.9%. Silent tariff-free corridors open wide. The WTO's alarms blare louder and louder. Chinese goods rerouted through Vietnam, Cambodia, Mexico, repackaged, relabeled, sneaking past customs with clinical precision. U.S. Customs reported a 23% spike in Vietnamese imports even as Vietnam's exports to China ballooned mysteriously. Coincidence or a masterclass in coordination? The chessboard is rearranging itself. Scholar Jennifer Hillman nailed it. Tariffs aren't stopping Chinese trade. They're redirecting it, sometimes strengthening Beijing's position. This isn't a trade dispute anymore. It's a full-blown economic conflict with global stakes. And it's already underway. Then came the next strike. April 3rd, BYD, the colossal Chinese EV powerhouse, announced a staggering $10 billion mega investment in Valencia. 2 massive auto plants, a next-gen battery gigafactory, a deep-sea export terminal with direct lanes to North Africa and the Middle East. BYD's biggest foreign foray yet. A calculated, devastating move. They're not just racing Tesla. They're outflanking it. After dominating for 3 quarters straight, BYD is now planting a sprawling European base capable of cranking out 800,000 vehicles a year by 2028. This isn't growth. This is revolution. Spain's deputy prime minister hailed it as the engine driving Europe's post-carbon future. But beneath the green rhetoric hides a razor-sharp motive: strategic leverage and global power. While Washington clings desperately to tariffs and walls, fighting to defend eroding turf, Beijing redraws the world's economic map, $1 billion deal after another. Europe isn't a bystander, it's a participant. No country has opened its doors wider to Chinese capital than Spain. The EU's latest foreign investment screening report shows Madrid slashed approval times for foreign investments by 43% in early 2025, outpacing even the bloc's most ravenous trade hubs. Brussels' reaction? Muted discomfort. Berlin and Paris? Alarm bells ringing. Both capitals view Chinese investment not as benign partnership, but as a creeping strategic threat, a long-term assault on their industrial sovereignty. Yet the deals roll on. The trains keep running. Ports keep humming. The world isn't waiting. It's racing, fast and unrelenting toward a new order. While Europe dithers and debates, China surges ahead. BYD storms into Europe just as Trump reignites the trade war, slapping steep tariffs on EU automakers. German car makers, once Europe's industrial pillars, are trapped. Crushed between US tariffs blocking exports and Chinese EVs flooding Eastern Europe with cutthroat prices and massive state backing. This is not competition. It's economic warfare. Europe's industrial lifeblood is draining fast. Behind closed doors, the question haunts. Is China systematically dismantling Western trade access, one electric vehicle at a time? Publicly, US allies echo hardline trade rhetoric. Privately, data tells a different story. Chinese electronics imports to the EU jumped 16.4% in early 2025. Supply chains aren't collapsing, they're shifting. Australia, a Western stalwart, sent 21.7% more lithium to China, even as it reaffirms military ties with the US. This isn't accidental. It's a strategic hedge. The Western alliance is cracking. France and Japan pivot quietly. Airbus doubled Chinese sourcing, locking in $2.3 billion with state-linked firms. Japan publicly backs tech controls but imported 11.2% more Chinese chips. As a former US official said, allies say one thing and do another, hedging commercially. The public and private narratives are splitting, and if permanent, US influence will erode to hollow allegiance. Washington struck back April 6th, blacklisting a dozen Chinese firms like TTL and SMEC. But the blow backfired domestically. $412 billion in US retirement funds tied to Chinese stocks forced massive sell-offs and volatility. Earlier, the Hikvision ban drained $3.7 billion from emerging market funds. The turmoil repeats. Indexes are reshuffled. JP Morgan warns of global fund stress. A leaked SEC memo fears a financial meltdown if US-China decoupling continues unchecked. This isn't a strike. It's a seismic tremor shaking the global financial core. Back home, the fallout hits hard. US inflation soared to 4.3% in March, fueled by surging import costs on electronics, car parts, essentials. Meanwhile, wages fell 0.6% year over year. Real incomes shrink. Small businesses buckle. 30% now list tariffs and supply costs as their biggest worry, triple last year's rate. Manufacturing is tanking. ISM index plunged to 47.2, lowest since early COVID crash. Economist Mohammed El-Arian warns, rising prices, stagnant wages, declining output are a recipe for stagflation. The last time took a decade to fix. This time we may run out of time. Globally, faith in US financial leadership crumbles. In 90 days, foreign US Treasury holdings plunged by $138 billion. China slashed $31.6 billion, lowest since 2009. Japan withdrew $23.4 billion, Saudi Arabia nearly $12 billion. These aren't minor shifts. They're exodus driven by risk and currency volatility. The 10-year Treasury yield soared to 4.89%, up nearly a full point in months, making credit costlier for everyone. The CBO warns every 1-point hike adds $2.2 trillion to national debt over a decade. Former IMF economist Desmond Lockman cautions, if foreign buyers flee, the Fed may have to hike rates amid recession. A disaster spiral of capital flight, stagflation, collapse. Here we stand on the brink. If Treasury demand craters, the dollar weakens, trust shatters, inflation devours middle-class stability. The system is fraying, unraveling. It's not if, but when it breaks. And who will bear the fallout when it finally buckles? This isn't a cycle. It's a shift in global power and finance, and it's already underway.